Great. Good morning. This is the meeting of the Police and Fire Retirement Commission. Today is July 12, 2022. I see that we have a quorum, and I'm going to call the meeting to order. I am Joe Simo, the chairman of the committee. Nikki, do we need to do any more formal of a roll call, or can we proceed?
You can proceed, sir.
Very good. We had minutes from our last meeting, and I'm talking now only of the public session minutes, circulated before the meeting. Did anyone have any comments, questions, proposed changes? And if not, can we have a motion to accept the minutes of the meeting of May 3rd, 2022?
Make a motion to accept the minutes.
Second. Those in favor, aye.
Aye.
Anyone opposed? And with no one opposed, those minutes are approved. I'm going to call on Mr. Jones, our financial consultant advisor, to provide us with an overview of the investment markets since our last meeting. We are not going to go into any detailed review of particular managers, as we will follow Mr. Jones's presentation with moving into executive session to discuss the management of public funds. Ian, I turn it over to you.
Great.
One second. Did you go into executive session as in closed
No,
session?
not yet. No, not
Okay.
yet. Not
Just
yet.
checking. Thank you.
Great. Thanks, Joe. And good morning, everyone. So we put together a flash performance report as of June 30, and I've included some updated market performance through the close of business yesterday. That's the document that I emailed out this morning, had that one additional page in it. And from an agenda standpoint, we'll start out with a customary review of the markets. We will then go into executive session and review the specific plan detail, asset allocation, manager performance, what have you, and give a couple quick updates on housekeeping items like the documentation with the 2 new private managers. And then we will have a discussion on current asset allocation. We've recently funded an infrastructure manager, and so we have to make some tweaks to our asset allocation targets. And corresponding with that, we may have to adopt some revisions to the investment policy statement. So in looking at market performance, a little bit bigger, this page represents market returns through June 30. And as many of you are probably painfully aware, we've gotten off to a really difficult start in 2022. One of the worst starts for both equities and fixed income combined in a number of decades. And when you look at year-to-date results for public equities, we had double-digit losses across the board. And you can see that, and you probably hear referred to in the financial news, the concept of being in a bear market. And a bear market is where the market has cumulatively lost 20% or more. And basically, we were at roughly negative 20% with the S&P 500 at the end of June. At one point, we were even lower than that. When you look at medium, mid-sized companies and small, they gave up a little bit more. The Russell mid-cap and 2000 indices were down between 21 and 23.5%. One of the stories in 2022 has been the performance of growth versus value. And as you may recall, growth has been the place to be for quite some time, and there's been a reversal. Growth has had the most difficulty, and many of the stocks that have led over the last number of years have given up the most in value. And many of those stocks are in the technology space. And I'll show you a little bit of detail on that in just a minute. And the market indices are market cap weighted indices. So bigger companies have a bigger impact on performance, both on the upside, but also on the downside. And I'll explain that on the next page. But the growth index was down about 28, and the value index was down roughly 13%, a little less than 13. And then the international markets were negative as well, but a touch less negative than our domestic markets. The MSCI EAFE index, that stands for Europe, Australia, and Far East. That is representative of developed markets, similar to the United States. And that was down about 19.5%. And the emerging markets were down 17.6. One of the things that is not evident from these international market returns is that these are returns in US dollars. So we convert the local market return back to a US dollar return. And the US dollar has strengthened relative to many foreign currencies, and that takes away from return. So if we were to look at these returns on a local currency basis, they'd actually be better. But the US dollar strength has been a detractor when you convert back. So a tough beginning to 2022. Year to date in the bond market has been equally difficult. I shouldn't say equally difficult, but double-digit returns, which we haven't seen for quite some time coming from fixed income. And basically when you have rising interest rates, rising rates causes the price of bonds to fall. And so these year-to-date numbers are largely reflective of the price depreciation in the underlying bonds. So high-quality investment-grade US bonds, represented by the US aggregate index, were down about 10.4%. High-quality corporate bonds were down about 14.4%. High yield bonds down a little bit more than 14%, and global bonds, they were down just under 14%. Now we have higher yields. There's a column here called yield to worst. And what yield to worst is just a more fancy term for yield to maturity. And so if you hold the US aggregate index now, till maturity, you're going to get about a 3.7% yield. And 95% of returns in the bond market are driven by yield. So these are fairly reflective of sort of what to expect as long as you don't have any defaults. And so if you look at the now yield to worst for the corporate high yield index, you get about 8.9%, which is pretty attractive, but you only get that if the companies that you lent money to pay you back. And they have to pay their interest, and they have to pay the principal value of the money they borrowed back. But that's where you can make some money if you have a good manager that does credit analysis and determines, what companies will survive and pay you back your loan to them and the interest. Pretty attractive yields in the high yield market. And also you get about 4.7% from investment grade corporate. So these yields will help dampen or erase some of the losses going forward, because like we began the year with about a 1.8% yield from the aggregate index, and we're about 2% higher than that. So that'll help erase some of the negative returns in the quarters and years to come. So then this is the page that I added this morning. And so these are returns for the market through close of business yesterday. And I guess the positive aspect is that we've had a little bit of an uptick in the equity market in the month of July. You can see little bit better than a 1, almost a 2% return coming from US equities. Interestingly, over this relatively short, 11-day period, growth has done a little bit better than value. Growth is up 3%, value is up 0.82. And we've had a little bit of a positive return coming from bonds. Investment grade US aggregate bonds up 0.2 and high yield bonds are up 1.6%. So year to date, the returns are a little less negative than where they were for our domestic indices at the end of June. But then when you look down, when you look at the sectors, energy, as a result of higher energy prices and better corporate profits and earnings within energy companies, are leading this year up about almost 30%. If we look back a couple weeks ago, you would have seen returns upwards of north of 50 to 60% in the energy category. And whoops, sorry. And then I mentioned, those companies in the growth space that led in years past, and we show those down at the bottom, and we refer to those as the FANG stocks. And you can see that double-digit losses, and a company like Netflix down 70%. But when you look at the 10-year return for these companies, you still see solid leadership. And these are the companies that drove a lot of market performance over the last 10 years. But they were quite pricey relative to earnings that they're generating. So basically, when you come into an environment where people start to question the growth potential for companies within that space, that's when they can pull back in price, and they can pull back in price significantly. One takeaway here, though, is that even with the market losses this year, we can't ignore the fact that over the last 10 years, inclusive of these most current losses, at least with the S&P 500, we're running still above a average return for the S&P going back to 1926. If you look at the last 95, 96 years for the S&P, we've had an average return of roughly 10%. And over the last 10 years, we still are annualizing out at 13.3. Interesting to note that the market low after the global financial crisis was March 9th of 2009. And from March 9th of 2009 until 12/31 of 2021, the S&P annualized out at 18.8% per year, 18.8. So we had an amazing run from the bottom of the market after the global financial crisis. And unfortunately, this is sort of part and parcel in investing in equities, is that, it comes with bumps in the road. And right now we are going through a revaluation process where we're sort of coming back to earth and hopefully building a base so that the market can go higher. The challenge today, though, is the uncertainty, and the uncertainty is related to factors like rising interest rates, the inflationary outlook, what the government's going to do from the standpoint of raising rates to try to take the consumer out, which I think they're doing a pretty good job with getting the consumer out of the market, and that will impact eventually the inflationary pressures which we've experienced. But we also have issues related to COVID tied to the supply chain, and the supply chain is basically getting enough goods, because inflation is driven by supply and demand. So the consumer creates demand, but then if there's a small level of supply, that can impact the inflationary front because there's greater demand for a smaller number of goods. And when you have COVID-related concerns and a lot of goods come from China, or a lot of inputs, and China is very aggressive in terms of having a zero COVID policy. Then if they shut down like they did Shanghai, which is a big exporter of components and goods, that impacts the supply chain. So that has that's one of the factors as well that is causing the issue today. And then you have the global, the macro factors stemming from the Russia and Ukraine crisis, and that has geopolitical risks related to it, and also supply chain issues relative to energy and wheat and other products that that part of the world what had been producing. So I'm going to stop there and see if there's any questions. Any questions? Okay. So
With that, concluding the overview of markets, I think we want to move into a review of our particular managers and some decisions we left open from the prior meeting. And so I would like to have a motion to move into executive session to discuss that management of public funds issue.
Motion to move into executive session.
Second. Those in favor?
Aye.
Any opposition? Having none, let us